Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Namaskar and welcome to the latest episode of State of Economy, where we are going to talk about some of the high-frequency economic indicators released during last 2 days, and even on Monday, one high-frequency economic indicator, which is Purchasing Manager Index, has been released. To talk about all those things, we have with us Upasna Bhardwaj. She is Chief Economist with Kotak Mahindra Bank. Welcome to the latest episode of podcast, Upasna.
Thank you, Shishir.
Upasna, let me start with the GDP number, which comes to be, people are saying that it is a shocker. And this is second shocker in last 21 days. First, we had the retail inflation at 6.2%, and now the GDP growth at 5.4%. How do you read this number?
Yes, Shishir, I think, the GDP number clearly has undershot any of the estimates that were existing in the markets. We were looking at about 6.5% growth, and clearly it's much lower than that. So it has shocked all of us. Now, if we look at the breakup of each of these indicators, clearly it is a very broad-based slowdown, especially across the industrial sector. The manufacturing segment, the mining, all of this has been extremely weak. And that is the reason. If you look at consumption demand, basically the private demand side, that too has been weak. So it has been fairly weak. And now if we look at on hindsight, we also had the release of fiscal data by the center. And, even, last 2-3 months, while compared to Q1, the government spending has increased. But if you look at the capital expenditure side, it is still not picking up at the pace at which we would really want, because, capital expenditure has a much bigger multiplier, and that tends to have a much more long-term impact on growth. So that is still wobbly at this point in time. So clearly this number is very weak. And but having said that, if you look at all the high frequency data, this is a quarterly GDP number that comes out with a lag. But if you look at the data which has been released after that for October and a little bit on November, then what we see is things may have troughed out, and we are probably seeing a slight pickup in activity. October probably, the pickup could be exaggerated a bit because it was a festive linked period. It was a period full of festivities, and maybe the revival is temporary, but we'll have to wait and watch. What we do see, however, is that Q3 and Q4 should be seeing better data compared to Q2. So hopefully and probably the Q2 numbers were the worst, and we keep that besides, and we see a better H2 over H1.
Okay. So can we say that the Q2 number was just one-off, and the growth range which was projected in economic survey, that is 6.5 to 7%, while RBI is saying 7.2%, many of the other research agencies are talking about 7% or 6.8%. Going by all these estimates and going by the number in Q2, do you think that even the 6.5%, which is on the lowest band, lowest number, may not be achieved?
Yes, totally agree with you. We have actually revised down our GDP estimates to 6.1% for the full year. So
Okay.
obviously the H1 is sharp, and largely because of Q2, it's very low. And as a result of which, even though we are looking at a marginal pickup in activity in H2, we still believe that the full year number will be less than 6.5%, and we are actually at 6.1%. In order to arrive at a 6.5%, average H2 GDP will have to be 7% or a little above that. So we see that being a little difficult. We think that there is a little bit of fatigue, as I said, slow pace of capital spending by the government. Urban demand is witnessing fatigue. And at the same time, there is uncertainty on global demand, which could have a bearing on exports. So I think we need to keep all of this in perspective. And I think while, like I said, we are looking at the next two readings above 6% for quarterly GDP compared to sub 6% in this quarter. But nonetheless, overall headline GDP for the full year will not be really way off from a 6% handle.
Okay. So you talked about urban demand, you talked about consumption. So if we see the GDP, GST number, which was for the month of November, of course, that is related with the goods consumed in the month of October or services availed in the month of October. On a monthly basis, there is a decline. On the yearly basis, there is just 8.5% growth. Is the GST numbers are also showing that consumption is on the weak path?
I think the decline of month on month that you're referring to could also be because, collections for October means it's a reflection of, fewer number of working days because it was a festival period. So some amount of collections take a hit like that. And
Mhm.
having said that, if you're looking at a Y-on-Y growth, clearly there is a slight amount of moderation that is there. But, we've had a very strong base on GST
Mhm.
continuously even at times when overall tax collections were taking a hit during the pandemic and post that as well, we did see because of better compliance, better incorporation, that GST growth was significantly higher than even the nominal GDP growth. Now, today, where we stand, the GDP growth and the GST growth, nominal GDP growth and the GST growth, are more or less in sync with each other.
Mhm.
So there is no such conflict or contradiction now. I think they are moving in sync.
Okay. But if I take the income tax collection data, there the growth is 15%. And if we talk about the YTD data of GST, that is 9.3%. So it seems that the income is rising, but the expenditure is not following that. Is it because of high inflation?
Yes, so there are different drags for consumption demand. For example, we know that the last couple of years, we have seen the saving rate having come down significantly. So the consumers were leveraged and they were consuming out of their savings. So this is one important aspect. At the same time, of course, inflation remains elevated, as you mentioned. That too has a bearing on purchasing power of the consumers. And all of this does have an impact. If you see after a one-off pickup in the first quarter GDP for consumption, we have again seen a deceleration. So clearly, as I mentioned before, we are looking at a, slowing urban demand. And that is a reflection of all of these factors. There is also a regulatory clampdown on unsecured lending. That too is having a bearing on slowing consumption. So all of these factors cumulatively are pulling back consumption demand.
Okay. Now coming to the PMI manufacturing number, which is a joint 11th month low. Does this mean that the manufacturing activities in the month of November has also been affected, and that, as you rightly mentioned in response to GDP numbers, that the Q3 number could be below 6%. So again, the manufacturing will be the real culprit.
No, no, I expect the Q3 number to be a little above 6%.
I'm sorry. I'm sorry. I will.
Yes,
Okay.
I think that the August and September readings were the worst. And overall, this is, see, manufacturing PMI is a soft indicator, not a real activity indicator yet. But yes, it does give us a signal as to how the outlook is going ahead. So softening, but at a level you see 56.5, which is reasonably robust still. So I would not read too much into this marginal slowdown. We still have to await more hard data for November to validate the trends.
Okay. Now, Upasna, coming to my last question is about the inflation. That the retail inflation number, which will be another high frequency economic indicators, which are going to be released on 12th of this month. What is the reading you are expecting?
So we are somewhere close to 5.7% for the upcoming inflation reading. And so, if we look at where RBI was during their October policy versus after that, we've had a 6.2% release. And now this number is also somewhere in between 5.5 to 6% inflation. So, cumulatively, the average third quarter inflation is going to be 70 to 80 basis higher than what RBI had estimated, 2 months ago. Now, this is something which will have a bearing on RBI's policy. This week end we have RBI policy, and in the backdrop of a sharp slump in GDP in the second quarter, and at the same time, sharp upward revision required for the inflation reading. That's where the dilemma for RBI would be. Now they have to weigh the balance of risk, which side, that is going to be crucial going ahead.
So the rate cut, the wait will be longer. I mean, even in the month of February, do you expect any rate cut, or should we wait for the next fiscal?
No, I think, we were earlier looking at a rate cut possibility in next fiscal only. But now, after the GDP data, clearly there is, scope for rate cut, which has been preponed. And I think February is when we are looking at a high probability of repo rate cut. But having said that, even before that, in the upcoming policy in December, we are expecting RBI to acknowledge this kind of it's basically setting the ground for an action in the February policy. So we have to wait for their guidance, how much of the revisions on growth and inflation happens, and what is their forward guidance. More so, I think we are interested in seeing what is their guidance and action on liquidity. The banking system liquidity is turning tight. Structurally, there are a lot of reasons, and RBI is one of the major reasons, because they've intervened heavily in the FX market and sucked out fair amount of domestic liquidity. So, RBI has to take measures to, starve off that deficit in liquidity, which has been created. Now, to what extent they can manage is through CRR cut. And will they really deliver a CRR cut in an environment when rupee is under pressure and, of course, inflation is high and growth is weak? So it's a big dilemma for them. They're really in a trilemma, I would say, situation. And they'll have to handle this very delicately. So we are expecting a possibility of a CRR cut right now, followed by a repo rate cut in February.
Okay. Upasna, thank you very much for talking to us.
My pleasure.